Good evening, traders. I'm Himalay Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we have been discussing about the Dow theory, and we have already covered the first four principles of it. Now, in this episode, let us try to understand the fifth principle of Dow theory, which states the volume must confirm the trend. Now, there is a very big misconception amongst the beginners. They think that volume should be high when there is buying in the market and volume should be weak when there is selling in the market. But that is completely wrong. Volume indicator is neither buyer specific nor seller specific. Volume indicates that number of participants that have been actively participating in the market for a given action. Now that given action can be of either buying in the market or of selling in the market. All right. Now this principle, please remember, is one of the most important principles out of all your six principles. Not only it will help you in your basics, but it will also help you a lot in your advanced level of technical analysis. So make sure you understand this principle very well. Let's take a few examples. Now, I suggested that when there is selling in the market, volume should be good. Why am I saying that? Or when there's buying in the market, volume should be good. The reason being, the trend will only and only sustain if the volumes are good. If the volumes are weak, the trend will not sustain for a long period of time and you can expect a reversal in the market. So we have an example over here. This is HDFC Bank day chart. There was a big downtrend in the market. All right. And what I do is I use the trend line, and for the same period, I plot the trend line on my volume indicator, which is at the bottom section of your investing.com. Now, for this period, what am I seeing is the volumes have been increasing for this downtrend. That means this downtrend has sustained for a long period of time. So you can see the selling had started around near 1,1250 rupees and it made a low of about 750 rupees. So there was nearly a 500 rupee drop in the stock. All right, so volume should always and always be good. Similarly, if there would have been buying in the market, I would again have wished for high volumes in the market for that trend to sustain for a longer period of time. So again, let me reinstate, volume indicator is neither buyer specific nor seller specific. For a given trend in the market, volume should always be high, except for a case of consolidation. In case of a consolidation, the volumes will be low. Consolidation means a sideways market. All right, in a sideways market, the volumes will be low. Otherwise, in your bullish as well as the bearish trend, the volumes should be high. So let's take a case of a divergence over here. In the previous episode, we understood the term divergence. Divergence means contradiction. So what sort of contradiction are we seeing over here? For a given trend, there is a decrease in the volume. So let me give you an example. I see a downtrend over here. All right. And for the same period, the volumes have also been decreasing. And it is pretty evident on the chart that this downtrend could not sustain for a longer period of time. And from here, there was a reversal in the market. And we saw the prices to move on the upside. So I think from around your 1200 rupees or so, the prices made a high of around 1300 rupees. So that was nearly a 100 rupee price jump. So what has this divergence acted as? It has acted as an early warning signal for the trader. It has alerted me beforehand and it has told me that this downtrend would not sustain for a long period of time because people are not interested in selling the stock over here, right? What does the volume indicate? So if there's buying in the market, if there's a bullish trend and the volumes are increasing, it shows that more and more people are willing to buy the stock And if more people are willing to buy the stock, the uptrend will be sustained. Similarly, if there's a downtrend and the volume is increasing, it shows that more and more people are now willing to sell the stock. And since there is selling in the market, that downtrend will sustain. But in this case, it did not sustain. And what the trader had to do is had to wait for the right entry time and the right entry point, and he could have long the stock and made a 100 rupee profit per share over here. I hope that clears your concept. So let's take a look at one more stock, Dabur. Now this is covered under your Nifty FMCG. All right. Let me see for a particular case over here. Perfect. So there has been a downtrend in Dabur. And for the same period, what we will do is we will be plotting a trend line on our volume indicator as well. And there has been a downtrend or a decrease in volume for this downtrend. That means more and more people are not willing to sell the stock. And from here, you can see how the market reversed. All the trader had to do is patiently wait. He already got an early warning signal over here. All he had to do is patiently wait for that entry point, and from there, we see a huge upside movement in the stock. All right, so this is a very important concept. Make sure you practice it. And if you have any questions, feel free to reach out to me. My number is 730-397-0083. You can drop me a WhatsApp and I will help you out. And if not, then we will cover your doubts in your live doubt clearing sessions. I hope you learned from this session, and I hope to see you in the next session soon. Thank you.